All right, options traders, listen up. I want to tell you a bit about public.com, but first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees, and in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 options contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. To recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading and start earning up to 18 cents per contract traded only at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome to Chit Chat Stocks. Today we are joined by recurring guest, I think we can call it at this point. Been on a number of times onto this show, and it is Leandro. He is the author of Best Anchor Stocks, a phenomenal stock research blog. And today we are talking about a company that most Americans are definitely familiar with. It is John Deere, and Leandro just had a long form research piece on John Deere with a wonderful title, I'll also say, John Deere Cultivating Technology. I thought that was really well done. But why don't we, I guess, kick things off with, first of all, welcome to the show. And then secondly here, how did you come across John Deere to begin with?
Well, first of all, Brett, Ryan, thanks for having me. I think this is, I don't know, I've lost count, maybe the fourth or fifth time I come to the show. So yeah, the title actually was the first title I came up with. Sometimes inspiration comes, so it's great to know that you liked it. So how I came across John Deere was actually interesting because I saw a tweet of someone who was reading a book called The John Deere Way. The book goes about it's about the company's history, but goes up to 2005. But well, that gave me that just led me to look at Deere in a screener, because I typically when I don't know what to study, I will maybe go over the company in a screener, read the proxy statement and all that, and then I will make the decision to study in depth. So I looked at it through a screener, and I saw the huge debt load, and also that the stock had a massive run since the pandemic. So that made me almost pass on it, but I decided to give the book a go, because I love reading about corporate history, especially these companies that have been operating for so long, right? Because you get to learn what makes a company durable or what makes a company great. I read the book, and then after reading the book, I realized that maybe the screener was not as accurate as I thought, and I decided to dig deeper after finishing the book.
Okay, and we'll get to specifically what makes people, when looking at the screener, it's almost similar to an automotive company that has the financing arm, but we'll get into the details of that throughout this episode, I'm sure. And I think we did have some people ask that on Twitter specifically, so I guess we'll hopefully answer that. But let's get to the segments here. John Deere, or Deere & Company. People listening, especially in the United States, will recognize that it has the tractors that they see, or if they're in a residential neighborhood, maybe the lawn mowing equipment. But where do they make their money? Where are they actually selling to customers? How does this all work? What's driving this business in 2024?
Yeah, so basically, before maybe digging into the segments, just it's good to give a glance at the numbers, right? So Deere generated around 61 billion in sales in its fiscal year 2023, with a net income margin of almost 17%, right? So it's a very big business and also quite profitable at this point. So as you said, the company basically sells agricultural and construction equipment, right? And then all the related service and parts and all the related revenue streams that come out of that. So the company can be divided in two large segments, right? Two main segments. The first one is equipment operations, and they make money selling the equipment and then servicing this equipment and selling additional parts. And also that we probably will go over this later, also the technology part. And then they have the financial tech segment. So in equipment operations, there are three main sub-segments, right? One is production and precision agriculture. This is simply put where they sell the large equipments and all the related technology, right? The Deere decided to start technological agriculture in the large equipment because it's where it makes the most sense right now. I mean, if you have a huge crop, then very small improvements in yield thanks to agriculture can yield like very good returns. So they started there, and this sub-segment makes around 43% of sales, right, of the company's total sales. And as it's a large equipment, and the customers are mainly the large farmers in the US, in Brazil also, it's less usual to see large equipment in places like Europe, right? Because the farms are much smaller. They distribute them exclusively across the dealer base, right? So these dealers are exclusive dealers for Deere, and they basically buy the equipment from Deere and then resell it. Well, resell it. It's new, but they resell it to the end customer. So Deere doesn't sell the equipment to the farmer. Deere sells the equipment to the dealers, who later sell the equipment to the farmers. Then you have the small agriculture and turf, which probably a lot of people have seen this, right? Even if you don't have a farm, is the smaller equipment, and also the equipment that you see in golf courses or in people's houses. This is around 23% of sales. And this one is distributed across the dealers, but also through big box retailers like Home Depot and Lowe's, right? Because obviously the target customer is different. And then finally, you have in equipment operations, construction and forestry, which, similar to small agriculture, makes around 23% of sales. I mean, it's called construction and forestry, but forestry is like a minimal part of this, right? It's 2%, I think, of the company's total revenue, and so construction is 21%. So much more weight to construction. And this is also distributed across the company's dealer base. And then what's interesting is that they have a financial segment, but many people get scared when they hear about this because they say, okay, leverage. I mean, let's say that a lot of bankruptcies start with something related to financials and leverage. So Deere uses this as an enabler of its equipment operations, right? So it's not the main business. And as you said, Brett, is similar to what many auto companies do. I'd say it's similar, but at the same time, it's different, right? Because this is a financial segment that is very tailored to a niche, whereas and the customers are the same customers that have been working with Deere for many decades. Whereas in the car industry, each consumer is different, right? So it's very difficult to see how they will react in case of a recession. And the financial segment is around 8% of sales. So that's basically how Deere is structured.
And then can you talk about how they use and I think if I'm remembering correctly from your report, they use the finance arm not necessarily as a profit generator, but kind of to grease the wheels of the agricultural industry, and why that's necessary for farmers that may have, I guess it might just be a liquidity issue.
Yeah. I mean, when you're buying equipment as a farmer, it's a significant capital outlay, right? So to facilitate the sale, what Deere does is finance that that purchase. Actually, many people think that the equipment makes, even when you finance it, the equipment doesn't make up a large portion of a farmer's cost, right? A lot of people think it's like huge, but in reality, it's like 15%. I mean, herbicides and pesticides have a much higher weight on a farmer's cost structure than the equipment per se. So Deere came up with this so that they could basically allow the farmers to renew rather recurringly the equipment. And what you said is really important, right? Because trouble always comes when a financial segment is trying to maximize profit, but because then is when you start to take more risk. But in this case, Deere is fine with an okay return. Obviously, they want to make money, but they don't want to maximize the money they make. But it's more facilitating the purchase decision of the farmers, right, and enabling the equipment operations to sell systems. So I think that's important because it takes away quite a bit of the risk embedded in any financial segment.
Can we go through some of the history? You mentioned that you read the book on John Deere's corporate history. So what do you think? I guess just go through how this business was started and maybe any important points surrounding its corporate history.
So the company has a very long history, but I'll try to summarize it so we are not here 2 hours. It was founded in 1837, so it's more than 180 years old, and it was founded by John Deere in Illinois. Right? Many people see the tractors now, but Deere actually started in agriculture, but back then there was no mechanization. So what John Deere invented was a steel plow. And this sounds like stupid innovation, right? Because plows already existed. But the problem was that in Illinois, the soil was sticky. So farmers had to stop lowing and they had to clean the plow every time until John Deere came up with a steel plow. So the horses, this is actually funny, and I think I mentioned it in the report. There are some similarities between John Deere and Hermes because they were founded in the same year, and also both had to adapt to the arrival of mechanization. Right, Hermes started doing accessories for horses, and Deere started making equipment for horses in the agriculture industry. And in the 1920s, mechanization arrived, and Deere tried to come up with a tractor, but they were not good at it. So they decided to buy their way in, right? So they bought the Waterloo Gasoline Engine Company, and they started manufacturing tractors. They had very successful tractors, but the next significant event came in the 1960s when they presented the new generation of power event. So Deere saw that to keep up with the needs of the agriculture industry, they needed to basically have more power in the equipment because the farms were getting very large, and it required a lot of iterations to go through all the farms. So then that's the next era of the company, to manufacture more powerful equipment. And then just 3 years after this event, Deere became the largest company in the industry for the first time in 1963. And they have never left that spot. So they've been, since 1963, they have been leading the industry. Then the next era of the company got kickstarted in 1999 when the company bought NAFCOM. So NAFCOM allowed them to include GPS signal in the equipment, and that was obviously the starting bits of what is now going to become autonomy, right? So since 1999, I know that many people think that Deere has basically started now to invest in technology, but Deere made the first tech acquisition, so to say, in 1999, so 25 years ago. And then the last relevant event probably came in 2017 when the company made its largest acquisition in history. They acquired Wirtgen, that is a company that was the leading company in road building equipment. And actually that was a bit lucky, right? Because they bought the company at a fair price in 2017. But of course, they probably didn't expect the huge wave of infrastructure investment that was coming our way, right? After with the 2021 Infrastructure Act, I mean, they're going to be a beneficiary of this trend. So yeah, I mean, it's a large history, but it's one of leadership, especially since 1963 when they became the largest company.
So you mentioned 1963. That's, I think, doing math in my head here, over 60 years ago now. What has enabled them to maintain this leadership in what some may call a commodity market, where it's like you have, okay, this one tractor versus another? It's almost like a Honda versus a Toyota versus a Volkswagen. Why are they so, quote unquote, sticky with their customers, as you talked about in your research report?
Yeah, so I think that if you ask any Deere customer, he'll tell you that probably the most important reason is the dealer. And this is the dealer has a very important role for several reasons, right? The first one is that most farms in the US are family owned and they have been passed from generation to generation. So they have a very good relationship with the dealer and they are used to to Deere's equipment, right? I recall reading in the book actually that during the Great Depression, a lot of families could keep their farms because Deere was nice to them or the dealers were nice to them in enabling them to pay later, right? So they extended the payment terms. So obviously they are very grateful for that, and they keep choosing Deere because maybe it's their grandchildren that are running the farm now. And then the other important part is that the density of Deere's dealer network is superior to other competitors. And in the agriculture industry, it's very important to have a dense network because the downtime is basically like, well, farmers can't afford downtime, right? Because you harvest over very short periods, and if your equipment is not up and running, then you potentially could lose all the harvest. So I'd say that the dealer is probably the most important part of the moat, and obviously there's more, but I think we'll talk about it later. Also, the installed base is important, especially now that technology is coming into play. But I mean, there's more. I agree that it's a commodity-like market, right? It's one tractor versus the other, and they have very similar technical specs. But at the same time, there's much more playing a role in the farmer's decision than just the technical characteristics of the equipment. And as I said before, also the equipment makes a lowish portion of the farmer's cost, right? So there's not a very high incentive to switch once you are used to one type of equipment.
Can we go through the relationship with the dealers a little more here? So what is it, almost like an auto dealer in a way where they're independent? It's kind of feels like a franchisee type relationship where they are using John Deere's name, but they are running their own separate business. Is that basically the arrangement?
Yeah, that's how it's organized. And actually, Deere started incentivizing dealer concentration, right? So some dealers started buying others because that makes them more efficient. But yeah, I mean, dealers are independent, and but obviously they are in close contact to Deere, especially to manage inventory, right? This industry is cyclical. So Deere also doesn't want the dealer channel to be bloated with inventory, because then when the downturn comes, it's when you start to suffer. And obviously, with technology coming into play, I think it's going to be more important to keep the inventory tight, because obviously an equipment can get obsolete quite fast.
Okay, and you mentioned this is in the United States. What about international? I know that's United States is their biggest market, but Europe, Brazil, other places, is this relationship still there, or is it something they're trying to build out, or is it different in these markets?
I mean, it depends on the geography, right? In the emerging geographies, Deere has an established position, but sometimes doesn't lead. For example, in India, Mahindra is the number one player for tractors, and but for example, in Europe, Deere still leads, but not by such a wide margin as in the US. The reason is what I mentioned earlier, that the characteristics of US farms are much more tailored to Deere's large equipment, which is the best, and where Deere has the highest market share. And maybe in Europe is, for example, more tailored to smaller agricultural equipment, right? Farms here are not as large. A country where dealer will probably be quite strong because it shares similar characteristics with the US is Brazil. And in the latest earnings call, also management mentioned that in Brazil they don't have a constraint in the US to harvest, so they have several turns to the soil, so they can harvest several times during the same season. So that means that technology is going to be more important, right? Because you are like iterations, there are more iterations. So small improvements in one equipment can have like a tremendous impact on the income statement. But I mean, Deere is the leading player in the US and in large agricultural equipment. It also leads, I would say, we cannot make generalizations, but I would say it leads in other countries, but the leadership is not as strong as in the US. The only thing I would say here, apart from that, is that the fact that technology is now going to be more important and probably Deere is going to end up with more technology probably makes it somewhat easier to penetrate the emerging markets.
Okay, and that leads into this next question. We are going to talk about the technology stuff. It is important to their growth going forward. And as you talked about in your report, potentially already helped widen the moat and will widen it further. And I do have a follow-up on maybe, I think you talked about basically the farmers in Europe. I think the governments are incentivizing them to get bigger so the crop yields can go up, but maybe we'll save that for a follow-up for later. But let's hit the technology one. They say their main focus, it's right there in their first slides on their investor presentations. They say they want to modernize agriculture with technology solutions. Now, I think people would go, well, how exactly are you going to do that? And I think there's been a lot of, startups in this space. I remember one that was kind of famous, which I would call App Harvest, which is probably a little bit different than Deere technologies. But I think there's probably some skepticism, I guess, among, value type investors, people that are not willing to bet on, hey, what is the future going to bring here? Are we seeing it actually today? So I guess the questions I have are you confident that Deere is in a leading position here and can win with this strategy? Is it going to be competitive? And is it already showing up in the financials today? Just as an overview from an investment perspective and how this technology segment, can drive growth for Deere over the next few decades.
Yeah. So as I discussed earlier, this actually has been the focus for almost 25 years, right? But I think that there are two things that probably have, let's say, increased the penetration of technology in the agriculture industry. One is obviously technological innovation, right? Chips are much better now, so obviously, and tech is much cheaper. And the second one is probably regulation, because Deere knew that in the past they could make farmers more profitable with more power, but the availability of land to farm is decreasing, but the needs are increasing, right? So now power is not enough. They need technology to be more productive. So I think that's precipitating the transition to technology, but it's not something new. I think I am confident that they can achieve this. First, because they have been doing it for a long time, and also because Deere is the largest player, and spends quite a bit on R&D and has a great tech stack. Right, the tech stack has been built both organically and inorganically. So they have some things that they've done in house, but they also have made some tuck-ins, especially for robotics and automation. I think that when one thinks about technology, right, the first natural thing to think is that switching costs are going to decrease, right? Because obviously technology brings disruption risks. While I agree with that in most industry, I think that's not a very relevant concern for Deere. And the reason is that the tech improvements in the equipment have to come through data, right? And to collect that data, you need the install base. So you cannot come from scratch and manufacture, for example, See and Spray that Deere has, right? Because See and Spray basically is that Before, farmers, when they wanted to fertilize, they basically had to go or to spray a pesticide. They basically had to put it to all of the crop. That's changing now, because now one of Deere's equipment can go through all the plants, and they will detect real time what plants need pesticide and what plants don't need pesticide. So that obviously is very relevant for farmers, because the cost of fertilizers and pesticides have skyrocketed. I mean, you cannot develop that technology unless you have seen a lot of equipment go through a lot of crops, right? So I think it's somewhat different in that the install base is what fuels the software. I think it's also worth thinking about network effects that the technology can bring. I mean, this is probably a word that is used too much, also, especially and many times where it's not used the correct way. But I mean, farmers sell a commodity, right? So they are price takers. I mean, a farmer in Illinois cannot decide the price at which he is selling his crop. This means that they have to focus in their cost structure. And if a farmer is more productive than me, that because he is using, for example, Deere equipment thanks to technology, then that means that he can basically underprice me, right? So and still be profitable. So that means that a farmer that's not on the best technology will probably end up going to the best technology just to remain competitive, because they are price takers. And I think that's something that we can potentially see with Deere, even capturing more market share. I mean, their market share is huge, but if technology is going to gain penetration, which is probably inevitable because most of Deere's competitors are following the same steps, then probably the best technology will get the larger install base, and that larger install base will power the best technology. That's how I see it. And I think that the results are already showing in the financials. More in margin, more in the margin than in the recurrence, right? I mean, the margins. Just to give some numbers here, in the last down cycle that went from 2013, I think, to 2017 or so, Deere had mid-cycle operating margins of 16%. And at the end of this year, management expects that they'll be at mid-cycle earnings, and they are now expecting 21% operating margins. So that's 500 basis points improvement, and that's basically technology. In the recurring part, probably is going to take more to play out, right? The subscriptions and all that. But we are already starting to see that technology in the income statement through the margins.
So you mentioned the example of the pesticides not just being a blanket throw out there, targeted pesticides. They've made quite a few acquisitions. Do you have any other examples of how they're deploying this technology? Because I know most of the listeners here aren't going to be experts on farming techniques, but I think it'd be interesting to get some meat on the bone of what they're actually doing for their customers.
So another very relevant one probably is autonomy, right? Because right now one of the constraints of the agriculture industry is labor, and obviously you need to be in the equipment right now to harvest. But maybe in the future, not so distant future, I think management is expecting a fully autonomous structure as soon as 2025. You'll be able to leave the equipment maybe working at night, right? So then you don't have that labor constraint because you can go to sleep and keep harvesting. That's one of the other examples, but obviously there are more. I think that the other part is that they are going to help farmers learn how to be more productive, right? Through the John Deere Operations Center. Basically, that's where you control all your harvest. They'll probably tell you that when is the best moment to put the seeds, when is the best moment to harvest. So I think there's a lot going on, and I think it's a segment that's bound for technological disruption, right? Especially because if you think about it, we cannot. I don't think that governments are going to afford inflation. in the food space, right? We already saw what happened with that, and if they keep putting more regulation to the how you can crop, then obviously, or how you can harvest, then obviously it's going to have an important impact on inflation. And lastly, one thing that actually talked about Deere with Sri from SVN Capital, and he told me that in the US, and this is true, when farmers are not doing well, then the government will quickly grant money, or maybe give them tax breaks so that they can purchase new equipment and all. So that's obviously beneficial for Deere, right? Regulation can be is a headwind. Well, for me, it's a double tailwind. One because of this, and the other one because the other regulation is making technology inevitable. But at the same time, you could see it as technology being a risk, right? Because farmers are going to be less and less profitable.
Okay, let's talk about the management team and maybe the proxy statement a little bit. Obviously, this is not a founder-led company, as most people might imagine, seeing as it was founded in 1837. So who's in charge of the company today? What do you think of them? And maybe talk about their capital returns strategy.
Yeah, so I think the management team is very good. Right now, it's John May. I think he has been leading the company since 2017, if I'm not mistaken. And they have a clearly defined strategy, right? They want to make Deere a technology company. And I think that's something very important in the management team, or something that I value a lot. Maybe it's not as important for other people, is management continuity. I mean, in its 186-year history, Deere has had 10 CEOs. Obviously, this is skewed to the family CEOs, which were in place for 40 years, right? But of the last 8 CEOs, or no, of the last 4 or 5 CEOs, all of them have been at least at the helm for 8 to 9 years. I mean, that just demonstrates that they want, like the board wants the CEO to be able to implement their strategy. I think the best thing probably about John May is that the strategy might or might not work, but he's committed to it, and he has put all the resources of the company and all the employees behind it. So I think that's very important, right? Because in a lot of times you'll see companies that claim to be following a strategy, but then you see all kinds of different things in all the teams in the company. So I think that's positive. And I think that probably one of the best things about the management team and the proxy statement is the incentive system. I mean, it surprises me a lot when I read proxy statements to see how bad a lot of compensation structures are in the management teams, right? I mean, it's like they have been. It's like as if they were done by consultants. Oh wait, because that's who does that.
That's what, yeah. We got to pay the compensation consultants so we can excuse ourselves to get paid an adjusted EBITDA or on adjusted EBITDA metric.
Yeah, but, I mean, what's crazy is that you pay a consultant that doesn't know your company to set and doesn't know your company or the strategy to say to set the compensation structure, which obviously plays a huge role in both of those things. So before going over the incentive system, I think it's important to know where it comes from. Deere had from the year 2000 to the year 2009 had a CEO called Robert Lane, and he said that Deere was a great company for farmers, for every type of customers, for the employees, for the community, but it was lacking being a very good company for shareholders, right? The company was quite cyclical, and they didn't like that, and maybe focused on growth at all costs, right? And maybe protecting against down cycles. So he decided to add shareholder value added to the compensation structure in an effort to make the management teams focus on shareholder value creation. And surprise, it worked, right? When you change a compensation structure, it normally, and to focus on the right things, it normally works. When you see, it's crazy because when you look at the best compounders, you can find a high percentage of great compensation structures, right? And when you look at the worst performers, you tend to find very, very bad compensation structures. This doesn't mean that obviously if you come against a very good compensation structure, the company will be a home run, but obviously it's something that needs to be there. So the short-term incentive is based on operating return on assets and sales. And obviously they have different objectives for the financial segment, which the KPI is ROE, so return on equity. And the long-term incentive is based on shareholder value added, which basically it's probably one of the best ways to compensate management, because you compensate them to grow, but only to grow when it makes sense for shareholders. So when you are adding value, and obviously that makes management think a lot about the investments, because it's not like it's for me it's a very good metric because it focuses both on growth and on returns, whereas other metrics might focus just on returns. For example, I mean, if you compensate based on ROIC, then you can basically focus more on the return than on growing. Because maybe you don't grow a lot, but you are not putting a lot of capital on the line. But here you have to grow and grow in a profitable way. So I think obviously that has worked very well, judging by how Deere has performed and how the margins have progressed, and also the returns. So for me, this is one of the strong suits of the company. I mean, it's not a perfect compensation structure, but it's probably better than 95% of those that you see out there.
Yeah, I would agree as well on that. I think it's interesting when you said around the year 2000 is when they tried to make this switch.
2000, I think it was 2007 when he was going to leave. He just, well, before leaving, actually, 3 years before leaving, he put that.
Okay, so at the end of his tenure, but.
Yeah.
Well, I think the comparison still applies. That's when their shares outstanding started consistently going down, and they started, it seems like, returning capital through buybacks in a, at least, for a cyclical as best they can in a consistent manner. One thing on the ownership, you mentioned this in your article, the largest owner is Cascade Investments. And I know this probably is not going to be a game changer for anyone on the thesis, but can you tell the listeners what that is and how that actually might connect to Deere and why it can show that it's possibly, just a wide mode business?
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. And beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. So to give some examples here, you want to see Netflix's average revenue per member over the last 10 years? They've got it. Do you like to track YouTube's advertising revenue? They've got that too. If you want to see Celsius's revenue that comes from Costco, how much of their revenue comes from Costco, they also have that. So the breadth of FinChat segment and KPI data truly is one of a kind. I use FinChat every day to track and manage all my investments. I also use it to discover new investments. And if you want to get 15% off any paid plan, go to finchat.io/chitchat. That's finchat.io/chitchat to get 15% off any paid plan. The link will also be in our show notes. Earlier in the show, you heard us talk about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Yeah, so Cascade Investment, I think, owns around, speaking from memory here, maybe 8% of the company. And Cascade Investment is Bill Gates' investment vehicle. So basically, Bill Gates owns, I think a lot of people know that Bill Gates owns Deere, maybe not so much that he owns such a considerable chunk of the company. And this is interesting because Bill Gates is also the individual who owns the most farmland in the US, right? So I think he probably knows a thing or two about farming in the US. And I mean, it's positive to see him as a shareholder. I don't think it's, as you said, game changing or anything, but it's just like it's anecdotal, but also interesting.
Yeah, I think it's funny how I obviously am not there when he's buying this farmland or managing the farmland, but I think it might be funny that he's like, wow, we have to kind of go with Deere. There's no way we switch. this is our most important value add here, so maybe we should consider putting it in the investment portfolio. Let's move on to the valuation. Deere is cyclical. I think a lot of people get turned off on that right away. You look at it today, I think it trades at close to about 10 times earnings. But again, people, obviously cyclicals, it can be dangerous to invest when it has a low PE. So how are you valuing the stock as someone who wants to buy and hold for the long term? And I guess, is the company decycling itself? Sorry, I can't say that. And how could that maybe change things? How could, I think you mentioned in the article, it's dangerous to say it's different this time, but how could it actually be a little bit different over the next couple of decades versus the last few?
Yeah, so some thoughts on cyclicality there. I was very reluctant to own cyclical companies, maybe a year ago or so, until I read the book Capital Returns. Because if you own a cyclical company that's secular and where management knows very well the cycle and how to invest counter-cyclically, then you are going to have potentially management amplifying your returns, right? I mean, Deere is cyclical, but it's not like if it loses money in down cycles, the margins go down, but it still remains quite profitable in the down cycle. And another thing, I think a lot of people are probably worried with the current cycle, right? Because management has said that we are probably at the end of this year, we are going to be around mid-cycle earnings. And that's going to be, I think it's a mid-teens decline. And a lot of people are a bit skeptical, right? Because we've seen a huge run since the pandemic. But what management has stressed constantly, and what I think they are right. The current cycle, the cycles in the industry come from volume, right? So if people are renovating the equipment or the equipment is newer than the average, then farmers will defer their purchases. But management has argued that a huge part of the current cycle has come from price, and that's actually makes it different, because you can see a huge run without it being a super cycle, right? They've taken a lot of pricing due to supply constraint, and also because they are including technology in their equipment. When Deere starts with a technological application that they are going to apply to a machine, they're first apply to some of them, and then when it gains adoption, they will include it in every new equipment, and they will hike the price. So there's a lot of that going on too. So the variable to look at here is volume and not revenues, right? But a lot of people are looking at the cycle through the revenues. In fact, I think the average age of combines and tractors is around the historical average. So it's not like we're going to have a super down cycle. So they basically argue that by the end of next year will be around 90% of mid-cycle earnings, and that's what I use to value the company, right? I mean, I could do a pirouette and try to predict the agricultural cycle, but I don't think I'm going to do a better job than management doing that.
Yeah,
So
unless you can predict the weather, I don't think,
yeah,
Mother
I mean,
Nature can be a little
it's
difficult.
very tough, right? Because a lot of things go into the cycle. But what I think, or what I'm confident in, is that the cycle is not going to have an impact on the long term of the company. So I think that getting the multiples, maybe not the multiples, but the free cash flow yield, next year's free cash flow yield, is a good way to understand where the company is on a normalized basis, right? I mean, a lot of people will say that the down cycle is going to be much tougher, and that's fair. I mean, they don't go from an up cycle to mid cycle. They typically go through an up cycle, go through mid cycle, and then to the down cycle. But what an investor should care about, in my opinion, is about the normalized earnings, not about the earnings in the up cycle or the down cycle. And on the last question on decycling, I would say that it's possible and it will happen, but it will probably take, as I said before, quite a bit of time, right? I mean, we'll probably see that Deere is more profitable through the cycles before seeing that Deere doesn't have cycles. I think that's how one should look at it, because they are expecting 10% of they're expecting 10% subscription revenue, I think, by 2030. And that, together with the parts and all the service, will take around let's say the portion of sales that are recurring to 40%, which is considerable, right? But not something that will decycle a company. And also that's sales. Probably on profits is going to be a larger amount, because service, parts, and subscriptions are much higher margin than the equipment. So let's say that Deere ends 2030 in 60% of recurring net income or operating income. That's substantial, but I don't think it's enough to not suffer the agricultural cycle, right?
For anyone who is listening, they're not watching, I just shared my screen and showed some of the numbers, but to kind of quantify what Leandro's talking about here, and I know you mentioned that revenue is not the figure to track, but if you to demonstrate kind of the margin expansion and the share buyback and the impact it can have when a management team knows what they're doing, revenue has grown at about 4.3% a year over the last decade, and earnings per share has grown at 14% a year. Kind of just goes to show the margin expansion and how management has been able to take advantage of some of the ups and downs.
Yeah, and I think that's a good way of thinking about the next. Even if you don't want to, so I'll do my little valuation exercise here. So if you take the free cash flow that Deere is going to generate, probably by the end of next year, or the management's guidance, that puts the company around a 5% free cash flow yield, right? A decade ago is when you can argue that we are now in a peak cycle. And a decade ago, you could also argue, well, you know for sure that we were in a peak cycle, which was 2013. So if you get the 4% CAGR in revenue, and then you add a bit of margin expansion, that already is going to take you probably, and also the better cash conversion, right? Because when you are working with subscription technology and all the recurring parts, your cash conversion is going to improve when the equipment operations naturally makes a lower portion of the company. I think it's pretty fair to think that the free cash flow here can grow at mid to high single digits, right? And with the current free cash flow yield, I know this is an approximation and very napkin numbers, but it will take you to a higher than double-digit return, which for a company such as Deere, I think it's quite interesting, especially since you are taking for granted all the optionality, right? Because you're assuming that the company can grow at the same pace as when technology was actually not as important as it will be in the future. But obviously, it's impossible to know if technology is going to have a huge impact on growth or just on margins.
Okay, one question before we close things up, unless Brett has a couple more follow-ups. What do you see as the biggest risks to Deere as an investment, and then also like regarding their competitive advantage? Do you think there's any risk that this goes away over time?
Well, I think right off the top of my head, I can think probably the most important risk right now is going to be unions. Deere suffered a strike, I think it was 2020 or 2021. And obviously they had to stop their manufacturing for, I think, 5 weeks, and the new labor agreement is much more expensive than the last one, so that obviously has an impact on margins. You cannot probably see it in the financials, because at that same time there was a supply crunch, so basically Deere hiked prices, and then sort of the impact of the strike was sort of hidden. And they have significant labor agreements, I think, renewing relatively soon, probably one next year and one in 2027. So I think that's an important risk, but at the same time, I think it's a risk that should diminish for the same reason that I said, right? If 60% of your business is recurring and it's made less of equipment operations, then you are not as reliant on the manufacturing where the strike happened, where a strike normally happens, right? Because it's where you have the low value added labor, so to say, but it's also very, very important. So I think that's one risk. I say another risk that I have read about is the one on autonomy maybe benefiting smaller equipment, because if you have basically a system that an equipment that can be harvesting throughout the night for the whole night, maybe you don't need such a large harvester, right? Because you can leave the equipment working. That's a fair concern. But at the same time, you can think that Deere will probably have the best technology, and they also have small agriculture, right? So they could adapt to that. But they don't. They are not as leading in small agriculture than in large agriculture. So any transition that takes the company from large to small is probably not great for the Moat. I think those two risks are probably the two most important, and there's also been an FTC complaint that related to right to repair. So right to repair is a regulation that basically states that you need to, if someone buys equipment from you, they need to have a reasonable way of servicing that equipment, either themselves or being able to go to any third party provider. And they argue, and some farmers argue, that Deere is not allowing for that. And well, Deere says that 98% of the servicing or of the equipment can still be made by farmers, but that the 2% that cannot be made, it's that way because they could potentially damage there are environmental regulations in the agriculture industry, and the equipment is prepared so that the limits are complied with. So they argue that if farmers can access the software, for example, they could potentially change those settings, and then they would not be regulation compliant. I would say those three are the most important risks, but the one I would be most worried about, and the one that I am most worried about, is probably the unions, because it's something that's coming, right? It's not like something that's very far away into the future.
Right. And it has happened before, and it
Mhm.
probably will happen again. Yeah, makes sense. So, as we close things out here, in your article, which I should note is you made it free
Yeah.
for, I think, yeah, for this one. So anyone can go check it out. We'll have a link in the show notes there. But you write at the end of your article about how you have your best anchor stocks qualities. I don't know how many there are, but you have these tenets that you look for to basically show that it's a high quality company and qualifies as a best anchor stock. So how does John Deere fit or not fit within that criteria, and how does that make you think about owning versus not owning the stock?
Yeah, I mean, I think Deere fits with all of them. So if I go, I think the ones that we have not touched upon, I'll maybe double click on those, and the other ones, I think they are obvious. For the first one is experienced and aligned management. I think we already went over that. Deere actually likes to hire from within, and the current CEO has been in the management team actually since 2012. I think he was the COO before. Then the second one is proven track record of outperformance. This is pretty easy to judge. You just go back in history and look at it. Then you have the strong mode. I think we also went over this. Enjoying a long-term secular tailwind. Obviously, they are enjoying a long-term secular tailwind in that technology is going to increase in penetration in agriculture, and obviously the world demands more food, right? And the farmland is is reducing, right? And then you have construction, and the long-term secular tailwind is obviously everything related to infrastructure. Then you have optionality. I think that any tech company has optionality, because today we are hearing about autonomy, about see and spray, but we don't know what applications might come in the future, right? Deere can potentially do something around water management, for example, in the farm, which is also important. The sixth one is double-digit growth, which I think we already touched upon. Maybe Deere doesn't comply with, I mean, not 100% with this characteristic, but at the same time, you don't need double-digit growth to enjoy double-digit returns, right? I mean, if you are not expecting, if you are starting from a, let's say, reasonable valuation or maybe a high valuation, you do need double-digit growth to enjoy double-digit returns. But I think the valuation here in Deere is not as demanding. Then it's the eighth one is lower than usual volatility. I think this one might strike some people that it complies with this, but actually Deere, despite being a cyclical company, the stock tends to have a rather strange performance, right? Because instead of going down a lot after the down cycle starts, it sorts of consolidates for a long time over a tight range, and I think that's an indication, like that's the management saying that they believe the company is secular. Obviously, they have cycles, but to be honest, if the company does not comply with this, considering the huge buyback program and that they have a lot of cash generation capacity, for me it's fine, right? Because if the stock goes down a lot, I think they will retire a lot of shares. Then resilient during recessions, I think there are two ways to measure this. The first one is to go back to the past agricultural cycles and see how the company performed, and the other one is basically common sense. Deere has been operating for 180 years, so I think that they are resilient against recessions and world wars and pandemics. And the last one is reasonable valuation, which we already went over. I think that it can be summarized in the fact that I believe that Deere is a great company trading at a very reasonable price, right? I mean, there can be bumps along the way. Now probably a down cycle is starting. Nobody knows how long it might be, how short, but if you are thinking over the long term, I don't think that should really worry you. If you are thinking about your returns in 2 or 3 years, maybe you should be worried. And by the way, obviously this is not investment advice, but you can read the
Yes.
deep dive if you want.
Yeah, exactly. So thank you for joining us. Where can people find your stuff? I know there's a Substack and also Seeking Alpha, so both places.
Yeah. So
Yeah,
in
go ahead.
Seeking Alpha is Best Anchor Stocks, and then Substack is bestanchorstocks.com. So those two places. And also on my Twitter, I don't know how to say it now that it's called X, on my X. That with this.
Doesn't sound right.
Yeah, it's like when you say, "Yeah, I tweeted it. I tweeted something." What do you say with X? I X'd something. I don't know.
Yeah.
On my Twitter, which is at InvestQuotes.
Beautiful. Yep. And we have had Leandro on the show before, talking ASML, talking luxury stocks, talking. Oh gosh, why
Constellation
am I?
Software.
Yeah, exactly. Yeah, and Constellation Software. So all those type of companies covered at Best Anchor Stocks. So go check that out. We'll have the link in the show notes, or go check out his Twitter/X to get all those links as well. Thank you, everyone, for joining us. Let me hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in again, and we'll see you next time.